What's up, guys? Welcome back to DCA. So what we're going to do in this video is take a look at a new machine learning algorithm model that I've created, which helps us to supplement the DCA index risk model. So if you're new to the channel, the DCA index risk model is a machine learning algorithm model which helps us to identify market cycle peaks and bottoms. So that's the model down here on the bottom. This model, essentially, you can see that it's identified peak points in the market cycle back in 2013 in April, then in November of 2013, then in December of 2017, and then more recently in February of 2021. Now, what this model is attempting to do is identify when the market has simply ran up too far too quickly, and based on human behavior, based on the myriad data that we have that shows when markets reach this certain point, they're very likely to sell off. And that's exactly what we've seen in each case. You know, we have the data which shows Bitcoin going down 80% in each instance. So back here, we went down over 80%. But then back in 2018, we went down over 80% through the beginning of 2019. And now where we're sitting at, as we're trading just under 30,000 at the moment, you know, we have gone down approximately to the bottom. We've gone down over 60%. So this DCA index risk model accounts for a lot of this variation in the market, but it does so in a way such that we're able to still identify where market cycle peaks or bottoms will occur based on all of the data that we have dating all the way back to 2010. So right now with the DCA index risk model, we're trading at around 15. And you'll see that historically, this is a rather low level for the model. But you'll notice that if you go back to the 2013 cycle, where we hit this peak in November of 2013, we were down in this level below 20 for quite some time. So we finally got below this 20 level back here in September of 2014. And we essentially sat plus or minus in this 20 range, getting all the way as low as we got all the way down to 7. And we stayed in this level from September of 2014 all the way through June of 2015. So nearly a year we were down in this lowest risk level. Then back here in 2018, in November, when we had this huge capitulation event, we were in these lowest risk levels essentially from November of 2018 all the way through March of 2019. So not as long, only about 5 months, but we were still down in that level for quite some time. And now you'll notice that we've been in and out of this lowest level ever since January. So being down in these lower tiers is not something that's unique to this market cycle. We've done it in each cycle in the past, all right? And that's not to say that, you know, we'll only be down in this zone for 5 to 9 months like we were in the past. We could be there for a year or 2 years. The model's not attempting to identify or predict the future. It's attempting to tell you approximately where the market is at, given everything that we know about investor behavior. So that's what the DCA index risk model does. Now, this DCA index risk model that we have here, this bottom risk model, looks at various factors in the market, which I've detailed in prior videos. You can go watch those if you're interested. So I'm not going to go into that here. But what we're going to talk about is this new risk model that I've developed. So this new model that I've created, I haven't really given it a name yet. We're just going to give it a placeholder name for the moment, and we're going to call it the asset flow risk. So essentially, this model is looking at numerous metrics that the DCA index risk model is sort of blind to. So it's looking at metrics which are measuring various factors. It's looking at asset flows into Bitcoin. And I'm going to show you how it varies and how it can kind of tell you what may be going on in ways that the DCA index risk model would be at certain times missing, because the DCA index risk model isn't there to identify when people are buying into the asset. It doesn't really care about that. This new model that I've created is sort of looking behind the scenes and telling you when might money be coming into this asset that you might not see. Because during these bear market phases, you know, first of all, we should talk about what happens in a bull market and what happens in a bear market. Okay, so to think about how the asset flow risk model works, Let's suppose that you just drew a line. So I've drawn a line here from the point at which Bitcoin was released onto exchanges all the way through the current time where we're trading at around, we're right at around $30,000. So there's nothing scientific about this line. It's just for illustrative purposes here. So what you could do essentially, if we just did this, if we just did that and you looked along this line, you would have around, if you picked any point on the line, you would have around a 50-50 shot of the price being either above or below this line. So in essence, this has essentially been the average, not the average, but just the trajectory of Bitcoin over time. It's pretty much more or less smoothly traveled along this line. Now, what people struggle with in this asset is the fact that at any given point, so if we just measured some points along this line, and we'll do that by looking at the price range. So, and we'll really zoom out here. That it's 82% below the line in that case. And if we measure above it, it's, 600% above that line. And then the same thing goes more recently. It's 80% below the line. And, in the most recent bull market, it's, over 100% above the line. So that is what people struggle with. And, that's kind of why we have risk models, because we are attempting to identify, well, where are we likely to be in relation to some imaginary trajectory of Bitcoin? So, if you just continued this line and continue to draw it out further, you may expect something like $100,000 out here in 2025 or 2026, whatever this is. And I'm not saying to do this because that is not what you should do. That is not a good way to identify where the price will be. I'm just illustrating that this is what people struggle with in assets, in highly volatile assets like Bitcoin. They struggle with the fact that they often buy in when the price is significantly above this imaginary trajectory. And they capitulate when we're below this imaginary trajectory. But in reality, smart investors would be buying when we're below this imaginary trajectory and selling when we're above. So the exact opposite of what many retail investors do. So with that trajectory of Bitcoin over time in mind, what we can do then is come back and look at the DCA index risk model in relation to the asset flow model. And we can see how they're going to be similar in certain circumstances and much different in others. And with that specifically, we can see here that the DCA index risk model is sort of pointing out these market cycle bottoms. And so like here, it's saying that this point right here, this asset is so significantly oversold that we are very likely at or near a bottom. Okay. And the same thing with here in December of, December/January of 2018, 2019, just like the COVID event. And now recently it's telling you that, this may very well be a great time to be buying the asset. Historically, this is an amazing time to buy the asset. All right. And conversely, it's identifying these locations for you, like here, like we saw back here in December of 2017, like we saw in February of 2021, where the price was sitting at around, nearly $60,000. So you were essentially at the top. And some people may say, well, the asset continued to go up from there. So why didn't the DCA index risk model identify that? And that's because the DCA index risk model doesn't care about identifying the actual price top. It wants to show you where has the asset ran up to the point where it no longer makes sense to be holding the asset. It no longer makes sense to be sitting in Bitcoin. You should be wanting to shift into the altcoins now. And, if you wanted to stay in Bitcoin so that you could capture the $4,000 or, maybe $6,000 that were left in the market, by all means, go for it. But this model is simply attempting to tell you that, we are sitting here at around 58,000 or whatever we were at, and you should probably be getting out now. You should probably be shifting the profits from Bitcoin while you were accumulating down in these lower ranges. Now, what this model is, however, doing is looking at market participation metrics, and it's identifying different stages of the cycle because different participants are in the market at different times. And what we see is that this model begins to reveal some things for us. And that is essentially these points where the asset is being accumulated at. So the DCA index risk model is making lows, record lows at these point where we're sitting down at around 7, where this model was all the way at this time, all the way up at around 35. And it had just come off of a large spike. And that's because these points are going to tend to be points where retail market is capitulating. When you see these spikes like this, these are retail market areas of capitulation. And in essence, what we see is that smart money is coming in at these times and buying the asset. So we saw that multiple times in the run up into the 2017 market cycle. And then you see it again back here in 2019. So this particular event was accompanied by a large, in 2019, when we saw the price run up, it was accompanied by a large influx of investors into the asset. And the metric was able to capture that. Now, back when we saw this huge capitulation back here in November of 2018 into December of 2018, there actually weren't a ton of buyers back then. We see that essentially all of the buying done right at that time where the asset was capitulated, it was essentially done by a very small number of investors, in terms of large investors anyways. So this move right here was not heavily accumulated. It was accumulated at the time by institutional investors, but it wasn't a mass level accumulation. For instance, like we did see here at the COVID capitulation event. So notice that the DCA index risk model is telling you the asset is significantly oversold. And what we saw was that there was a big accumulation from a lot of the more savvy type investors. So when the asset plummeted from around $10,000 rapidly down to around wherever we were, around $3,500, we saw a huge wave of accumulation right there. We're seeing all of this accumulation forming as we dropped down into this bearish stage of the market. We saw that there was very little accumulation in these stages. And we did have a prior large level of accumulation right here in July of 2019. And then we saw a huge amount of accumulation again in 2020. But then what you saw was right around here in October, the amount of market participation, the amount of FOMO into the asset went parabolic. And it's these stages where you're typically nearing or very close to nearing the end of the bull run for this asset. And we're talking about Bitcoin here. So we saw this huge accumulation phase right here, which actually peaked in terms of looking at, it's not telling you absolute tops. It's not trying to tell you absolute tops. It's trying to identify for you sort of these euphoric phases in the market. And that phase actually peaked right here in January. Now, there was more accumulation, but you'll notice that the price, if we just zoom in here, we're just going to zoom in to how this happened. The price reached up to around 42,000 and it only went up about another 50% from there. All right. So right at around 50%, we went up from this price. In fact, just a bit less than 50%. And you are taking a huge amount of risk to be buying in at these stages. And that's what the DCA index risk model was telling you. You should not be buying at this stage. You should be moving out of Bitcoin into altcoins, which have yet to move. They had yet to do anything. And at the same time, you have all these idiots on YouTube telling you, get into the market right now. We're going to 250K, bro. And it was obvious that that was not going to happen. So we had the metrics telling us that we've reached peak euphoria in this asset. And from there, you saw bearish divergence, which made sense. The market started slowing down. Bitcoin was no longer making the huge moves it was previously making. And the asset accumulation was dropping off of a cliff. All right. And it's also what we saw back here. We saw the price, the price itself went all the way up to around 68K, 69K. And the DCA index risk model sort of reflected that. It went up to this 60 level. So indicating you should sell a small bit of the asset or, however you've set up your DCA index risk model. Again, if you're interested in seeing how I do it, you can go watch any of the prior videos I have on the model. But the accumulation index indicated to us that there was no accumulation. There was no sort of drive from investors to be buying this asset to accompany this price move. So this price move was very hollow in essence. In other words, there was nothing really backing it. It may have been, a small number of investors who were left around from the bull market. They were sort of driving the price up in addition to whatever sort of manipulations going on in the background. But there was no huge FOMO move into the asset like we saw typically in the setting of a bull market. So this metric would have identified for you multiple different types of things. It identifies where these accumulation phases are occurring. It shows you when we get these large spikes in the middle of what appears to be a market sell-off or a bear market. These are typically going to be large-scale investors accumulating in the background, buying more of the asset while the retail market is capitulating, selling the asset, like we said, if we go back to here, selling the asset at these times, buying the asset at these times. The big players are in the background accumulating the asset at these times, selling the asset at these times, all right? And we saw the same thing right here. So once we got above this level right here at around $30,000, you see that we reach our peak FOMO phase right here, right in January. And after that, it's all downhill from there. The risk model goes one more run and it gets up into the 90s. And from there, it sort of dumps off. So there was all this indication that the market for Bitcoin anyway, and likely the entire market as a whole, was going to dump because as Bitcoin loses its momentum, typically the altcoins then go on a 1, 2, or 3 month run and then everything dumps. And that's exactly what we saw, guys. So I haven't exactly finished this model yet. There's a few changes I want to make. I'm not sure how I'll distribute it yet, actually, but as per usual, I'll let you guys know on the Discord channel. You could head over to the Discord channel to get updates on what I'm going to do with this model. And the DCA index risk model, you could sign up for that on the Discord channel right now. So by the way, this is a free model you could sign up for on the Discord channel. So that's going to be it for this one, guys. I hope you guys would like this. I think it's a very useful model, and I think it does a lot to sort of show us things which are going on in the background that may be hidden to us otherwise. So that's it for this one, guys. Until next time, as usual, see you.